Hello. We are finishing up the balance sheet. So this is the last thing we're going to talk about, and what we're going to talk about basically is reporting equity. So let's get right on that. You should actually already know a lot of this stuff. The statement of retained earnings reports how the company's retained earning balance changed from the beginning of the period to the end of the period. Remember that retained earnings is the equity earned by profitable operations that is not distributed to stockholders. So it's retained, right? Companies can report negative amount in retained earnings. This is called a deficit. A deficit is a debit balance in the retained earnings account. A deficit occurs when a company has recurring loss or declares dividends in excess of retained earnings. So you don't see that a lot, but it could happen. I think you've seen these before, statement of retained earnings. Exhibit 310 on page 667 shows the statement of retained earnings for Smart Touch Learning for 2016. So Smart Touch Learning didn't have any retained earnings at the beginning of the year, so there's a zero. Their net income was 8,550, so you add that. They paid out some dividends, so you take that out. And their new retained earnings, 5,550. Nothing new at all there. All right, so that's it. You know all about how to report retained earnings. You already did. So isn't that nice? Something you don't have to learn. All right, so how do we use stockholders' equity ratios to evaluate business performance? All right, so this is the last part of the chapter. Talk about a few ratios. These ratios we're about to talk about frequently are used more by investors looking at companies, trying to decide, do I want to buy that company's stock? Right? If I bought that stock in that company, I would have equity in them. So how's their equity? Is that a good idea? Do I want to do that? So we're going to talk about some common ratios that people use to evaluate companies. Investors are constantly comparing companies' profits. To compare companies of different sizes, we need some standard profitability measures. 3 important ratios to use for comparison are earnings per share, rate of return on common stock, and price-earnings ratio. So this lets you look at different companies, right? If you know you want a certain rate of return, 5%, it doesn't really matter if the company's big, small, what industry they're in. You just look at that rate of return, right? So you can compare things that maybe aren't otherwise comparable by using these ratios. Earnings per share. So this is the final segment of a corporate income statement, and it reports the earnings per share. So if you were to go out online and look up Coca-Cola Company or Walt Disney Company or Microsoft or Apple, you'd see them reporting earnings per share. So we already understand earnings, right? You look at the income statement, revenue minus expenses, net income, earnings. So earnings per share is the most widely used of all business statistics. EPS is the amount of a company's net income or loss for each share of its outstanding common stock. Earnings per share equals net income minus preferred dividends divided by weighted average number of common shares outstanding. So you just take what they earned, and you don't count the preferred dividends, because that's really more like a debt. And you divide it by the shares, and every shareholder gets this much earnings per share. It's an easy way to compare one stock with another. What was its earnings per share? Every owner who had stock got $5 for every share they own, $2 for every share they own. So it doesn't really matter what the company is, what its size is. You care about, if I own a share, how much do I get? So here's an example. Net income for 2013 for Green Mountain is $483 million and some change. Preferred dividends are 0. The average number of common shares outstanding is 151 million and a few extras. And FASB requires the earnings per share be reported on the income statement. And there it is right there, EPS, $3.19 per share. So now you can compare any other company and see what their earnings per share was, and you'd know their owners, whoever owns their stock, are they doing better or worse than owners of Green Mountain Coffee Roasters? The PE ratio. This is another very common ratio that people buying stocks like to think about. The price-earnings ratio, or you'll hear it called PE ratio, is a ratio of the market price of each share of common stock to the company's earnings per share. Right? Doesn't it make sense? I mean, if I'm going to have to buy that company, I have to pay for its shares on the market. So what are their shares selling for? Now I compare that to what I can earn, right? Earnings per share. So the price per share divided by earnings per share, and it tells me if that's a good measure or not. So PE ratio equals market price per share divided by earnings per share. So the market price for Green Mountain is $75 and the EPS is $3.19, resulting in a PE ratio of 23.5, right? So how would you know if that's good? Well, you'd want to compare it to another stock. So a bigger ratio might be better. Of course, there's a lot of depends on there. Is it like a reliable company? Is this going to make, is it dependable? You might want to look at the PE ratios over a period of time, right? Rate of return on common stock. The rate of return is also referred to as return on equity. The return equity shows the relationship between net income available to common stockholders and their average common equity invested in the company. So the formula for this is net income minus preferred dividends divided by average common stockholder equity. So Green Mountain has returned 20 cents for each $1 of the average amount invested. A rate of return on common stockholders' equity of 15 to 20% is considered good. I'd say that's real good. 20%, 20 cents on each dollar. That's a good rate of return. Right, so that is it for chapter 13. So this will be your last exam before the final. So that's pretty cool. Now congratulations on getting all the way through all these chapters. See you at the exam.